Oh, Dave, 10 years ago, March 2009, investors like you and I were miserable cusses. The S&P had lost about half its value. The S&P hit the devil's number of 666. And boy, if we'd only all bought then, because you look at it today and the stock market is up more than 300%. There was money to be made back then. And 18% annualized increase. It's just remarkable.
Right. Well, and we haven't had an official bear market in that time. We've only had a couple of 10% corrections. A 10-year span like that is remarkable. In fact, it's never happened before in the recorded history of the stock market.
And the question is, how long can this good luck last? And neither you or I really have any idea.
No, I wouldn't want to venture a guess. Only to say that things look okay right now for the next few weeks, a few months. There are no big storm clouds on the horizon. There are plenty of risks out there, from the China trade talks to to the Middle East, to some financial instability in Europe and Brexit, North Korea. You can run down the litany of things that could upset the apple cart. But
all of those things seem to be elsewhere besides the United States.
Yes.
But they certainly still have an effect on corporate profits, because roughly about 20, even if you invest in U.S. companies, major U.S. companies, about 25% of the revenues comes from overseas, which kind of explains the dip we had almost to bear market levels in December. Worry over that.
yeah.
The Fed came out and said, well, we're not going to raise interest rates, and everybody cheered and said, oh, wonderful, and the stock market went up again. But it doesn't mean that there can't be a little bit of bad news. It sends it right back down.
Now, I have talked to some professional investors, strategist types. They say we're late in the cycle, which is an inexact term, but they think we're closer to the end than to the beginning of this bull market. So they recommend being a little more defensive, buying like healthcare stocks rather than the growth kind of stocks that take off, or the cyclical things that take off early in a recovery. But with the Fed on hold, I mean a lot of recessions are caused by the Fed overreacting, raising rates too high because they're worried about inflation. The Fed seems to have eased off this time, and they're not too worried about inflation. They'll be on hold until they get signs of a stronger economy. So we may not have any interest rate increases this year. Certainly not for a few months.
Now, somebody, if there are any lessons we can draw from the last decade, and certainly the lesson you draw from 2008 and 2009 is the American economy is a powerful machine, and you should not lose faith in it, even when things look awful. The chances are that this industrial machine will revive and do well for you. And basically, if anybody who had courage to buy during 2008 and 2009 did extremely well, and you can say that even about December. Anybody who bought December 23rd, December 24th, when we're down recently, almost 20%, has recovered.
Oh, I think the lesson for investors is just don't let your emotions get the better of you. I mean, there will be ups and downs. It's the stock market after all. But if you take the long-term view, certainly as we sit here, you've done pretty well.